What's up, guys? I'm Nobody Special, and we have a special episode today. With me, I have Melody Wright from the M3 Melody Report on Substack, and I have back on the channel is Laks Ganapathi, the CEO of Unicus Research, also the author of the Unicus Substack. And Laks, I spoke to you last week, and after we had the interview, it was actually about 2 weeks ago now, and it was very well received on the channel. And I remember as soon as we finished talking, I said, Laks, you have got to talk to Melody, because you two have been, through two different angles, you've been attacking this avoidance of price discovery and the hidden delinquencies in the ABS market. And I really wanted to get you two together to talk. And of course, as soon as you guys started talking, you started blowing up my inboxes, my Gmails, my Twitter. I just knew you guys were going to hit it off. So I'm very happy to have you both on the channel. Laks, welcome, and welcome back. Melody, you as well. Welcome back.
Thank you. Good to be here. Very interesting times.
These are very interesting times. Let's jump right into this. Laks, I kind of wanted to build this whole episode out of this tweet that you posted. This was a couple of days ago on May 10th, shortly after you and Melody spoke. And you're talking disaster 2.0 in the making here, some pretty strong language. And then you touch on a couple of different areas: mortgage, auto, consumer credit, buy now, pay later, student loan, and ABS deterioration. Some believing we're in a perennial bull market. That seems to be the prevailing wisdom. Nothing stops this train.
No.
Talking about the great discussion you had with Melody, who witnessed the GFC from the inside. We both agree that our economy has been in a silent depression. And then you kind of hinted this video. Stay tuned with Laks MacArthur, M3 Melody, and JG Nuke. Well, here we are.
Yes.
So let's just talk about these subjects one at a time. Let's go through each bullet point here, starting with mortgage. And now, Melody, mortgage, that's your bread and butter, right? You've been specializing in mortgage finance more than a decade now. What are you seeing in the mortgage market today? Go.
Oh, wow. Okay.
No, I just wind you up and let you go. Yep.
Okay. So we know that a lot has been going on. You know, I've been on your channel several times talking about FHA. We got the finally mainstream media went open kimono about FHA in a Wall Street Journal article. And a lot has happened since then, including the administration shutting down the more generous aspects of their COVID loss mitigation program, which is going to happen in September. Now, through the great work of John Comiskey, we can see how many borrowers kind of went back to the teal or were doing this over and over again. And really the never payers is what I would say they are called, because they just kept going into default. And so we know that anywhere between 200 to 500,000, and John's refining his analysis, could actually hit the foreclosure market. And again, that's just the referral. That's not the full foreclosure. That could take a very long time in certain areas. In other states like Georgia and Texas, it could go very quickly. So it just kind of depends on where you are. But we could really see a huge share of these foreclosures hit in Q1 of 2026. But that's not the only news. In that announcement was an old requirement that talked about that if there were any delinquent student loans, they would not be eligible for an FHA loss mitigation workout. And guys, right now the last report out there is over 12% delinquent on the FHA portfolio. That's a massive amount. There's 7.9 million people with FHA loans. And the only way, and this is the stat you love to talk about, Jack, there were 9 FHA foreclosures last year and 500,000 workouts. And so, guys, they're for these people that are going to be shut out of workouts, we are going to see quite a bit of distress. But going back to this little requirement that said if you have a delinquent student loan, then you will not be eligible for a workout. And so you're seeing several pockets of the FHA market. And in 2021, HUD told us that 45% of FHA borrowers had student loans. And so all of the things coming from mortgage that you and I have been talking about, Jack, almost ad nauseum, which is those rising property taxes, the increases in insurance, replacement costs, the fact that people haven't been able to do updates to their homes. We're seeing job losses, bankruptcies, these things, and just that crazy speculation, which as the travel industry is starting to suffer. I just tweeted something this morning about Mission Beach. I was just out there. It was deserted. You're going to see investors have to exit these markets. We've already seen it, and that's why we're seeing inventory growing. So at the same time that you've got inventory exploding, you're going to have issues in the mortgage market, and you're going to start to see these distressed properties. It's already happening right now. I see it in my client books. And so we should see in June is typically when we get the seasonal kind of first thrust in the delinquency, because typically you get caught up with bonus payments and tax refunds. And I'll know by the size of that how much distress we could really see as early as Q4 in the mortgage market. But things are getting, they're accelerating. We've been on this path, but certain actions by the administration have really started to accelerate it. And I'm trying to confirm right now when the servicers are going to be able to incorporate that check on the student loan borrowers. This is something they were always supposed to be doing, but I think that the debt was not being loaded into Kivers, which is a system that they share for federal debt. So I'm trying to get that confirmed for now, but that this is really big news. If these folks aren't eligible for loss mitigation, we're looking at a meteor coming for consumer credit.
So that's a pretty big development there that John found. And by the way, John Comiskey, you guys may remember he came on the channel a few weeks ago with Melody to talk about that FHA workout program. So you're saying if you're delinquent on student loans, which Laks has a fantastic chart later in the show, we're going to get into that, you will be ineligible for one of those FHA workouts, which are, they're not going away in October, or are they going away in October?
The more generous components are going away. So prior to, after the GFC, you had loss mitigation, but you underwrote the loan. They had to turn in documentation. When COVID hit, they created some really lax programs where you didn't even have to contact the servicer. They'd send you your modification in the mail. But this program in particular, Jack, was where you could just, the servicer didn't have to modify the loan. You would just go in and say, I haven't paid my mortgage in 3 months. They say, that's okay. We'll do this thing called a partial claim. We're going to put that unpaid balance at the back of the loan. And then they would not pay for 3 more months. And they would come back and they would say, give me another one. And you could do that all the way up to 30% of your unpaid principal balance. Now, what's going away is you don't get to do that over and over. There's a limit. You can only do that once every 2 months. Additionally, you have to put some skin in the game and do what you do with every other modification program, which is do trial payments. So the way that a loan mod works, or loan modification, is they say, look, this is going to be your new payment based on your new terms. That becomes final when you make 3 of those in a row. And that was not required as part of this program. And so they're shutting down the very lax components of it, but you'll still have some loss mitigation, but it will not be available to people with delinquent student loans.
Now, Laks, this is one of the reasons why I suggested that you and Melody should talk, because you came on the channel 2 weeks ago and you talked about auto finance and some of the ways that the delinquencies are swept under the rug. And it just rhymed a lot with the program that Melody was just describing. Do you see anything in the mortgage market along these lines? I know you've done a lot of work in some of the other areas of consumer finance. Anything in the mortgage space that has your attention?
Well, to be candid, we haven't done, we are aware of what's happening in the market, but we haven't done that kind of deep research on the mortgage. However, in agreement with Melody, the student loan defaulters is going to be a huge problem, because they just got away with murder, so to speak. And every time your loan comes due, you ask for forbearance, and then you push it and push it. There are so many plans. Save Plan is currently in a legal limbo. All those plans helps the student loan to be current and not default and kick the can down the road. And it overlaps with, there is a high probability that subprime borrowers will fall into the category of student loan defaulters. And whatever Melody said in terms of FHA, it is easy to deduce that that overlay will also include some FHA. Melody, is that right?
Yes, absolutely.
Yes.
Mm-hmm.
Yeah.
All right. So no shortage of issues in the mortgage market. among the many bullet points in this larger debt crisis that we're talking about here. Now, the next bullet point from your original tweet, Lux, is auto finance. Now, that was a subject we talked extensively about 2 weeks ago.
Yeah.
But just while we were talking here a few minutes ago before we hit record, you sent this one from the CFPB, repossession in auto finance. And, you know, there's never been a lot of clarity in the repo data. What's going on in this report from the New York Fed here?
So repossession is, auto industry is a tightly knit, complex cesspool. There is no other way to explain it. You have the OEMs, you have the dealers, you have wholesalers, you also have the repo guys. And repossession is one such data that even though it's there, no one really publishes it. There are a lot of politics that goes with it, but the repo data hasn't been publicly available. And CFPB today or yesterday published this data about the auto repossessions. And this focuses mainly on the data that happened in the past. It still doesn't reflect the current data. We spoke with a couple of wholesalers and a couple of repossession guys who has been in this industry for more than 25 years. Said something interesting. And we mentioned this in 2021 as well as 2022. One of the reasons the repos have not been happening as much as it should is because there was a lack of repossession individuals, people who are willing to work for banks to repossess the cars that are refused to be paid off. And one of the reasons that we keep hearing is the reason that the repo guys are not being paid enough to work for the banks. Let me clarify that. 20, 30 years ago, they paid $500 per car, according to our sources, to repo a car. 10 years ago, they paid $500. The lenders, like banks, paid $500 to repo a car. Even today, they are still paying $500. So the guys who are working with the banks or who have been working with the banks to repo the cars do not want to do that, because for them, they are being paid less and they don't want to do the work. As surprising as this sounds, they don't want to do it. Now, an interesting aspect happened. As of May 19th, the outstanding balance on the auto loans in the United States is $1.66 trillion. That's 11 billion increase from the previous quarter. The problem with this is a lot of banks are putting their lenders, after kicking the can down the road, like we discussed, 94-month auto loan, 80 months auto loan, 72 months auto loan. Then still if the borrowers were not able to pay, they're putting a notice to the repo guys to repo the car. Now they are having a problem to find the repo guys because the banks have to pay $500 per car and the repo people wanted more money. So according to our sources, there are a lot of people calling, especially after the student loan default started getting reported to the credit rating agencies. And I have posted a couple of things on Twitter where the credit score drops from 700 to 500. Consumers who are unable to pay $500 or $300 on auto loan every month are calling their banks and saying, come take my car, I no longer want it. And the voluntary, they call this voluntary repossession, and it's in the report that I just shared with you. When people are asking to take the car away, banks are refusing to take on the car. So consumers are pushing to the banks, here, take my car. I don't want to deal with it anymore because A, it's hard to maintain. B, I don't have money to pay for it. C, I don't want my wage to be garnished, so I would rather pay the money to the student loan rather than paying for the car. And that is really concerning. And as Melody said, a huge meteor is coming towards for consumer credit. And I am a little bit skeptical, especially regardless of your political affiliation. The current administration always it states a few things that they will do, and when actually the time comes to enforce those things, they back off. So question is, will they really going to enforce the wage garnishments for student loan borrowers who have been defaulted for so long? I don't know. I really don't know. I'm looking at a data that I shared with you, which I cannot find it. At the end of the repossession process, what happens is if the car is not otherwise redeemed by the lender, typically dispose of the vehicle. If the disposal is done through a sale, which we talked about, how they bank after they repo the car, they go to the auction to sell the car. The lenders are generally required to use a commercially reasonable process, which many of the lenders is through an auction. If the net proceed of the sale do not cover the full amount owed to the lender, and remember, this includes the current loan, plus if the consumer did a trade-off, then you have to focus on the negative equity that's still remaining. And any cost associated with the repossession of the vehicle, including the cost to clean or repair the vehicle, ahead of the resale. Now, I want to stop right here and say that according to the wholesalers and the people who are working in the auction houses, banks who are dumping the car in the auction houses are no longer repairing the cars. They are just dumping it as is. So if that goes to the used car market, anybody buying that used car have to put in money to do the work. So this is getting a problem because the banks or whoever is taking the repoed car to the auction need to clean the car, need to fix the car if there is a problem with the transmission and etc. And those things cost money in addition to what bank is willing to pay for the repo guys. So at the end of the complete repoing, selling it in the auction houses, the banks, the way it looks like it, the banks are not making any money. So the auction repoing is a huge problem, and student loan default is putting pressure on the credit score, which will force the consumers to not able to afford even a used car at this point.
So there's that student loan subject popping up again.
Yeah.
And there was a lot in that answer that really caught my attention. First of all, you mentioned the 94-month auto loan workouts, which just blew me away the last time we talked about that in our last interview. $500 to repo a car. And that's the same price that's been paid for 20, 30 years. I mean, repoing a car, that's some, it's not, as I said, often about commercial fishing, it may not always be fun, but it's never dull.
Yeah.
Those guys get shot at, they get stabbed, they get cussed at, beat up. I mean, all kinds of things. And for $500, $500 doesn't go as far as it did a few years ago.
Mm-hmm.
And so now we have a shortage of people to repo cars. So, you know, what stage of economic collapse is that when you're running out of people to repo cars? At least there's some work to be found if you're willing to put up with that. You've got people obviously don't want their cars anymore, trying to get the banks to take them back. The banks don't want to take the car back. And then on top of that, when they do actually go to auction, the cars are busted up, dirty, not cleaned. It's just a mess all over the place here.
It is. And to add, if I have a little bit of time, and I wanted to share this data, and I don't know if I can share it from here, is the average number of days between the repossession assignment, that is when the bank says, oh, this lender defaulted, he is right now in the repo queue. So the average number of days between repossession assignment and completion ranges from 16 days for consumers with super prime credit scores and 23 days for consumers with subprime credit scores. There it is.
So what are we actually looking here? The number of days between assignment and the actual completion. So how long it's taking for the repo guys to actually get the car. And interesting, it takes longer to get the subprime loans than it does the super prime loans. Any idea what's feeding into this data? Why the difference in time?
Well, the super prime, if the super prime is defaulting, I think they don't have any problem in giving it. With the subprime defaulting, they just don't want to give the car. And that is pretty much what you mentioned. If anybody willing to take the repo job, if you're not worried to get shotted or beaten up. So I guess that's the time that's, factored in.
I mean, I guess this is like, let's speak about this simply, right? Poor people sometimes fight back, right?
Yes,
Desperate people.
Well, they know they're street smart and they know the tricks. They know how to hide their car. They know how to, they're looking for the repo man. But I think that as well, just that assignment, we do this all the time with, like, say, property preservation or appraisals or whatever. There are just areas it is impossible to find someone to do that work. And so you often in certain areas have aging, like maybe Detroit or places like that. So, yeah.
Yeah, I once hired a guy to do some work on my condo. This was years ago. And I got a call from the homeowners association. This is when I was trying to sell my condo, that my contractor was parking on the sidewalk and he was chaining his truck to the transformer that was on my neighbor's property because the repo guy was following him around. Some people, needless to say, that contractor created more problems than he solved for me, and we had to let him go. But yeah, it's amazing what some people will do when the bill comes due. So, all right, auto is a mess. I think we beat that horse pretty well here. Yeah. Let's talk about consumer credit. Can I quickly
say something though, Jack, about auto? Yep. Because, so I came from a company, my former company was, both an auto and mortgage lender. And so very familiar with some parts of this world, especially on the dealer side. But what I think is absolutely fascinating is that Ally, who said, the only reason they got into trouble last time was because of the mortgages. That's your government-backed market. They went in just all the way on autos, and autos didn't have this issue last time. We always remarked how people continued to pay for their car because they needed to get to work. They couldn't pay for their house, and so we've now basically taken. We've got issues caused by the government in the mortgage market, and we've got actors in the auto market that just because there is no government that I see in that market, just went completely wild again. And so we're just really in each one of these components of the credit area or asset class, we are at the riskiest in all of them, which is just insane.
Yeah, I agree. And, Ally, they went all in on the auto market right around the same time the rest of the market was getting out. And with predictable results.
Right.
Yes. And especially when the consumers are in trouble. When Dollar Tree CEO announces in the conference call that their consumers are in trouble, it's a Dollar Tree store, for crying out loud. And if they are coming and saying that we have a problem, our consumers can no longer afford anything, what does it tell you?
Yeah, that's what dollar stores are left, right? Most of them are $1.25 stores now, $1.50 stores now. We don't even really have.
And the $5, and that's a scam.
Yeah.
All right, so let's go back to our list here, because now we're at consumer credit. All right, so which that includes your credit cards, your store lines of credit, and Melody, let's start with you on consumer credit. You sent some pretty interesting information over here. You found this report this is actually from the New York Fed, household debt and credit. So what's going on in this report as it pertains to consumer credit?
Yeah, so there's a lot of stuff going on in this report. We've got the hockey stick of the student loans. And if we go to that delinquency schedule on page 12, I believe the 90 plus delinquency, what you're starting to see. So you saw student loans shoot up. You also are starting to see it in mortgage start its upward trajectory. You can see the mortgage a little bit more in the 30 plus day, but you can look at credit cards and you can look at that level of delinquency. And so in all facets of the consumer, and what is this not showing you? It's not showing you buy now, pay later yet either.
Yeah.
So, but yeah, these credit cards, I mean, at these unbelievable, I mean, listen, guys, I can talk about this stuff because I was a very poor student and I've been poor more of my life than not. And so, you know, what happens when you have a credit card, you know, you're using it to buy your everyday essentials. And what happens when these credit card rates go up is that each month you're basically getting less and less and less. You have less credit because interest is taking up so much more of that space. And so you spend and spend and spend, and then suddenly you don't have access anymore, which is why I think, you know, Forbes said that 1 in 4 consumers are using buy now, pay later for groceries because they've run out of runway on their credit cards. And so, you know, to me, this is what I was trying to say, and I did it poorly. It's that we've got little fires in every single corner here, and that's what this schedule shows. But what this schedule doesn't show you yet is what I think is the impact of that hockey stick to all of these other asset classes. And so I think, you know, we're going to start to see things we saw back during the GFC, which is banks calling credit cards in, reducing limits. And so, you know, that's going to be very interesting when we start to hear that on conference earnings calls where people are going to be shutting down these credit lines.
So a lot of things going on in this chart. We're looking at the 90-day delinquencies now. Those are obviously your more severe ones. The red line jumps right out at you, right? That's your student loans. And, you know, I've shown some version of this chart on my channel several times over the last few years. And I've always said, hey, that student loan thing, that's not real. As soon as they pull back the curtain on that, it's going to shoot back up. We're in the opening innings of that. It's going to keep going higher. But there's other things going on here besides the student loan hockey stick. Credit cards.
Yeah.
The 90-day delinquencies in credit cards shown here in navy blue. That's rising pretty quickly. Almost, well, it is. It's GFC levels here, right? On 90-day delinquencies in credit cards.
Yeah.
Auto loans, which Laks just very eloquently described. Auto loan delinquencies, 90 days, already back to GFC levels. Now, mortgage, obviously, still much lower here, showing a 90 days past due. Mortgage is still down, you know, around 2%, along with home equity. But we have seen that chart start to rise higher. And as Melody described at the beginning of the show, that's where your FHA workout programs end. And Melody, correct me if I'm wrong, you said around first quarter of 2026 is when you anticipate that chart to start moving higher. Is that correct?
Well, for mortgage, I think we're going to start to, it really already is. If you look in the next chart, which is the 30 plus, you see a much bigger uptrend. But what I want to, and I wish I would have mentioned this, but I'm sorry. When I went to that private note conference in Nashville, Jack, I talked to some smaller servicers in mortgage who do things like seller financing. They do non-traditional mortgage. And what they told me is a lot of them aren't reporting to credit. And so the way that Experian or the way that Fed gets this information is they take it from Experian. And if it's not being reported to credit, it's not going to show up here. So what I came away from that conference, and this is something you and I have talked about a lot, is that there's hidden mortgage delinquency out there because we don't have one data provider who has access to it all. You have the Fed who tracks this schedule plus the commercial banks, but not the non-banks. You have Black Knight that tracks the non-banks, but they only have 30% of the mortgages, and they don't have a lot of the specialty servicers or the delinquent servicers on their platform. So this schedule is incomplete. It's not telling you the full story, but look at that 30 plus trajectory and understand that mortgage is so low because we've had 4 years of more aggressive loss mitigation than we had post the GFC. So that's why it's so low. But just think those that had that aggressive loss mitigation are running out of workouts. When do I think this will go up, Jack? Even more. It's going to be, we'll see our first big cohort probably in June for 2025. That's when you get your seasonal uptick in delinquency, and we'll know how large. But yes, by Q1 of 2026, we're going to have a a materially larger foreclosure population unless somebody intervenes.
Melody, I have a question, Jack, if that's okay. With the transition into delinquency, you mentioned something called a lot of servicers are not reporting to the credit agency. If you have to allocate a percentage, how much do you think it is? Because this problem also prevails in student loans. It also prevails in auto loans. So how much percentage do you give to that non-reporting?
So that's all we were talking about at the conference. How big is this? Like
Yeah.
how big? Because how big is seller financing, which is at one servicer 17% delinquent? I mean, that is absolutely insane. So how big? Nobody really knows. I think that, one proxy that I could probably do is look at all the non-performing loan sales that Fannie Mae and Freddie Mac have done and make some sort of proxy on some of that. But then you're missing
Yeah.
the shadow, the sub 2 guys who go contact a delinquent borrower, and that all happens under the radar. But, if I just had to take a swag, I'd say, I'll give you a number. I think we're at 6% delinquency for mortgage right now. That's where I think we are based on, everything that I kind of know and understand about these credit cycles. That would be my guess. Meaning we're far more delinquent than what anybody believes that we are in the mortgage market right now.
It's interesting you would say that because I was checking with a couple of our sources who used to work in that student loan as well as in auto. And what we are realizing is no bank wants to blink first.
That's right.
Because if X bank wants to go by the books and say, hey, I'm increasing my provision for credit losses because my defaults, both for vintages means any loan that is in 2021, 2022, 2023, the default number is increasing. So I have to increase my provision for credit losses. We were told that banks talk to each other and they'd say, we're not reporting it, don't report it. Who would stop this? I mean, not the accountants. I mean, somebody have to stop this. And there is a point where student loan comes in, reports to credit rating agencies. What I'm thinking, Jack and Melody, is that let's say for instance that garnishments government backs off, right? Let's just say they just back off in the last minute. Still, the student loan defaults are being reported to the credit rating agencies, and that takes 200 points hit, and that will be enough to trigger the consumer credit. Doesn't matter whether they are going to garnish or not. Even if we factor that out, consumer credit is still screwed.
Yes, I agree with that fully. Yep.
So two big things to take away from the combined answer there. Number one, I've spent a lot of time studying human error during nuclear, my days there. One of the more common human error precursors is when people don't understand what their instrumentation is actually telling them.
Oh, good one.
And they misinterpret what the gauge is reading is really saying. And Melody, what you're saying, because I see these Uber housing bulls and these Airbnb bros all the time talking about the low mortgage delinquencies, and they're citing this data that is missing the largest population of delinquent loans. Is not included in those statistics. So if you're one of those guys who's pounding the table on those low mortgage delinquencies, you don't know what your gauge is telling you, and you're making a mistake. I have seen this so many times. And then to Laks's point, what we're talking about with the student loans, and we're going to get into that in more detail in a second, these credit scores that have been used to gauge the risk on these mortgage loans, we also don't understand what that has been telling us, because student loans, these people are multi-year delinquent on loans, and it has not shown up on the gauge. So you're looking at the risk gauge, the credit score. You don't understand what it's telling you because it's not including the data that is very important to accurately gauging risk. So a lot of human error precursors are showing here.
And when you use an automated underwriting system, and this is what so many people don't understand, the GSEs, or Fannie and Freddie, had automated underwriting systems that told you whether a borrower was approved or not. And that was a large component of that is your credit score. And so, and then tack on that your lender didn't feel comfortable actually re-underwriting the loan to their standards because they could have been accused of discrimination. And if it was GSE automated underwriting approved, and I mean, I try to tell my clients so many times that credit scores were inflated because of these issues. They could not hear me. I mean, they could not hear me in any, and I even tried to tell them as recently as, we got that 41.8% rejection rate. I was like, are you guys seeing this? I mean, surely you are. Well, the files are harder, but now I'm hearing nothing, and we're getting, and origination has just stopped. Like, so to your point about the gauges, people are reading a gauge and they don't understand what is actually being reported by that gauge and how you come up with that. And so this is, just think about, think about that credit score.
The credit score it's inflated in so many ways. The credit score at this point is irrelevant.
Right.
If a student default is hitting your credit score and you're dropping 200 points, question is, were you ever in the super prime, or were you always been in subprime? And 2020 stimulus, as I think we discussed this, Jack, in the first video, during stimulus, everybody paid down, that increased the credit score. So all the loans that are bundled in ABS is similar to, or worse since GFC, is that the prime is actually a subprime or a deep subprime. So the tranches are completely messed up. So,
which, by the way, that was the don't dance scene in The Big Short, when the young guys from that hedge fund had figured out that the AA tranche of the mortgage bonds was made up of the same crap that made up the triple Bs. And so they shorted the AAs because the tranches were a mess, right? That's exactly the same trade there.
And this time is worse. Because you actually lifted, the United States government lifted the people who were on subprime thanks to stimulus. You get thousands and thousands of check, and you boosted them up to super prime or prime. And you see people driving nicer cars. And now it doesn't matter if the government garnishes, you have a problem.
Yeah, we've inflated their egos too, Jack. And I think this is an important psychological thing to understand. It's what fueled so much of that speculation. It's like, they didn't have to do anything to suddenly receive this credit score and to be treated like the super prime at these, at these lending facilities. And then, by the way, the other thing, just quickly, and I'm so sorry, but the other thing that's not showing up here are these alternative fintech lenders that they're not recording documents. They're doing home equity agreements. They're doing hard money lending. They're lending so you can spruce up your home before you sell it. The proliferation, there's no way to even track all of these, what you would call hard money lenders out there. And so when people talk about equity, like in mortgage, they have no idea. Because there are just so many ways to lend using your home as collateral that cannot be tracked.
One more thing I wanted to mention, Melody, that I feel like we all just kind of glossed over when you said it. You were talking about automated underwriting and approval. Yeah. Correct me if I'm wrong. Is that not the very definition of a rubber stamp? If you automatically approve and underwrite something,
well, theoretically, there's requirements under, but yes, they probably could have used better wording there. And nobody really know. You can figure out the algorithm, like how to cheat it, how to game it to get your approval, but they don't really tell you how they're weighting things in the back end. And so it's this big black box that you send things into, and it comes out saying approved or denied. And if it says approved, nobody's asking any more questions. And unfortunately, they approved. What I'm seeing in servicing books is just a hot, stinking mess of stuff. that are good. I mean, the lawyers are about to get real rich, put it that way. Always. That's a part of the cycle.
I heard from, I don't know if it is John, while I was speaking with John, that it's not John, it's somebody else. So he works at ABS in some big companies. And he mentioned to me on a call that there are a lot of opportunities for lawyers who has experience in CLOs and dealing with asset-backed securities. There is this, he's a lawyer himself, and he said, I am seeing a huge amount of people in demand. So when you said lawyers are going to get really rich, I am sure most of them are CLOs.
Yeah.
And I remember having this conversation with you, Lux. I really suspect the reason why the lawyers are so in demand in the CLO market is they're trying to put the language into these agreements to make sure they're first in line to eat when these loans default. That's when you really need the lawyers in the CLO market, is trying to figure out who's going to eat the loss and who's going to get paid.
You know what's very sad in that statement is that who's going to get first to benefit. But at the end of the day, consumers are always the suckers, which is very, very depressing. Walmart is going to pass on the tariffs to consumers. So consumers can't afford anything. And you see people hiring lawyers who expertise in CLOs, like you said, Jack, is to fine tune the verbiage so they can be the first one to get the money.
Which coincidentally means those same consumers are going to be the ones who take the loss in their pension and their mutual funds because they own the bottom tiers, or the language in the agreement means that their retirements will take the hit.
What
so
retirement?
You're right.
What retirements? There isn't any. I mean, the way things are going.
Yes.
All right. So we've talked consumer credit. Lux, I know this one, you can't wait to dig into this one. Buy now, pay later. We talked about this one a lot in our last interview. Real quick, I just want to mention something I saw this morning. This one in CNBC, just from this morning. UK clamps down on Wild West of buy now, pay later sector with new rules, basically saying these automated approvals that buy now, pay later is doing. It seems like the regulators are finally catching on to what's going on here, that they're just rubber stamping loans that they know people aren't going to pay back. What's going on with buy now, pay later these days, Lux?
Buy now, pay later, especially a firm. I have to check with my article that I posted with respect to the Affirm, is that Affirm started to focus on the higher tier of consumers who can pay back. They are throttling the loan for lower tier consumers who can no longer pay back. They are cutting the credit. They are also reporting the usage on a regular basis to credit agencies. In the sense, I believe they're using something called artificial intelligence tracking system to consistently report it to the credit rating agencies. This is good for super prime consumers. It will add them into a more reliable consumer group, but it's problem for consumers who are in barely prime, subprime, and deep subprime. You will see a huge amount of BNPL users to be cut off from BNPL credit. And that's the problem because, as Melody discussed or Jack discussed earlier, consumers are using BNPL to buy groceries. It used to be 14%, now it's 25%.
Amazing.
25% in consumers who are buying using buy now, pay later, and let's assume those consumers are subprime, has increased from 14 to 25% for groceries.
Now let's think about this a little bit. What recent series of events might actually cause somebody to suddenly fall out of that super prime category and into that subprime category, where now even buy now, pay later is cutting them off?
Student loan default. Everything it points to that. It does not matter. And I just thought about this when I was talking with the Melody and you, is that it doesn't matter if you're going to garnish. Let's just assume they are not going to garnish. I hate to repeat myself, but everything points to student loan. And the second they started reporting it to the credit rating agencies, people are dropping off from 800 to 600, 700 to 500. So that is having a cascading impact on BNPL, on throttling the credit by the regular commercial credit card companies, and your availability to Melody saying having an opportunity for FHA, and whether you can just shuffle it around. It's impossible at this point.
So you've got somebody's delinquent on their student loans for 5 years. It shows up on their credit. It dings their credit. Now they get cut off from buy now, pay later. 1 in 4 of them is using that to buy groceries. So how are they going to buy food? The car is already being repossessed, assuming the bank can afford to pay somebody the $500 and find somebody who's willing to get shot at for that $500. So the car's going away. I mean, Melody, ultimately, this is going to spill into your world in mortgage finance, right? If it really comes down to it, we're going to see this is going to trickle up the debt ladder to the point where people start missing house payments.
I mean, it's already happening, and you can. I mean, it is going. I think it's going to be a gradually and then suddenly type of event. But I think what I've always said about 2025 is that motivation will turn to distress. We saw motivated selling from the Airbnb bros, the boomers last year, the foreigners, buyers, they were selling. This year, you are already starting to see distressed sales, and I think this is why home prices are coming down. I saw it year over year and month over month in a good chunk of the cities that I track. And so you're seeing that weakness because people are having to cut prices now. They have to. They get that default notice because that's the thing. People will wait until they get that. It's called the breach letter that says you're in breach of your, and that's going to go out around day 45. But some of them won't act until they say, we're about to refer your loan to foreclosure. You need to call us. And so when you get that, that's when the person who's selling their property starts to, cutting prices, cutting. And then on top of that, we're actually seeing foreclosure sales because the VA they don't have any loss mitigation right now. They've got something under consideration in Congress. But once that starts, I mean, this is just, Jack, it's happening already. And I think that's what's so frustrating about the data is it's so lagged. And so we're sitting here and we know instinctually it's happening, but we don't have the data yet. Because all these things I talked about last year, we have the data for now. They did happen, but everybody's, they move on very quickly.
Data is not impactful enough, but it's a lag. You're absolutely right.
Right. So it's happening. Jack, can I bring up something, if you don't mind, that I just think is so critical that another thing we glossed over. So I knew this from my history. If you ever see a credit reporting file, you are going to lose your mind. These things are manual. So this is what the servicers, anybody that does report to credit, has to send out to the credit reporting agencies. And they are the most hideous looking files you will ever put your eyes on. And very manual, which is why you always have so many issues of what's on your credit report. And so, for instance, when we, as a leadership group, we always had to talk about our CFPB errors. Like if you were over a department and you got a letter that said you made an error, every month you would go through all of your errors. Well, who always had the most errors? It was a credit reporting crew because it's very difficult to report this stuff correctly the way that this is set up on the other side to receive that information. So I think that we are in the dark as well because you have very unsophisticated systems at the back end of these big credit reporting agencies. And I think that is something people need to understand as well as to why we have not been getting the full picture.
We've finally made it to student loans. And I know you guys have all been ready to go into this. We've touched on the student loan topic with every bullet point so far. Laks, you posted something on X recently. I think this was a screenshot from a Reddit forum that you posted, and I just wanted to read a little bit of this. And this goes to show you what's going on here. And well, let me just get into it. Help. Credit score dropped from 760 to 553. Delinquent on 8 student loans. And I couldn't help when I read that 8 student loans thing. I kind of had like a moment with Steve Carell in the Gentleman's Club in The Big Short. It was like, wait a minute, how many loans do you have? 8 student
8.
loans. Okay, so this is one of those career students. I woke up today to a notification from my bank saying an account has been reported past due. I went on to Experian and saw that 8 of my student loans have gone delinquent, and my credit score has dropped from 750 to 553. It turns out the account I had for my loan servicer, Advantage, had been inactive given it wasn't used for over a year. Furthermore, all notifications from Advantage about delinquency notices were also sent to an email I haven't used in over a year. Also, Advantage didn't send any mailed notices to my address. Now, this person goes on to try to figure out ways to fight this on the credit score because, oh, my old email, they didn't mail me anything. Look, dude, you didn't pay your bill for over a year. You're not getting out of this one. And the responses were kind of like, just get comfortable with a lousy credit score because you're not going to get out of this. 8 student loans, hasn't even logged in over a year, and now a 200-point hit to the credit bureau. So, I mean, this anecdote, it's a pretty extreme example, but I think there are probably hundreds of thousands, if not millions of stories like this playing out right now. And then you also sent me this chart here. So,
yes.
Just go ahead. What are we looking at on this chart?
Well, Melody was perfect in explaining that. I will give Melody a shot at this, and then I will get into the student loan nuances.
Yeah. So I think when I looked at this chart, I was like, okay. And I didn't realize that little line that was slicing up the light blue on the chart. And what that light blue section are the current borrowers in student loan. And if you are current, one would assume that you are paying money into your student loan repayment program. However, what this chart shows you is that, in fact, there's only a small percentage, or well, not small, it's a bigger percentage, but it's that are actually paying money back in their student loan repayment plan. You have this 4.5 million borrowers who are in a repayment plan and are being being reported as current, and they are paying zero. And so, guys, if they can't pay anything, it's likely that once they are out of that plan where they get to pay zero in their repayment plan, that they will become delinquent as well. And so I think that if you just cut that off and you pretend that little piece of the pie was orange instead of light blue, you look at it's not a lot of people repaying their student loans. Yeah. And it's going to become a huge issue, I think, for the administration, who will likely have to blink if you think about what the impact to consumption is going to be like, of which we're just now starting to see the first early reports and in the travel sector largely.
And folks, I just want to drive something home real quick. First of all, old data. All right. January 2024. A lot of people past due, 30%. That is 9.7 million people. A lot of people still in deferment, a lot of people still in forbearance, but about half of the borrowers are making payments. But of those half, a quarter of them are making payments of nothing.
Yeah.
This is the stupidity and the just outright, what I will say, dirtbaggery that's going on in our credit markets right now. How are you calling somebody who's making a payment of $0 current on their loan? This is how they massage the numbers to make them say whatever they want to say. This is degeneracy in a chart right here. I mean, I think they'd like you to ignore that little slice of paying nothing and still current on their loans. That's like the last slice of pizza that nobody wants to touch. But Melody, good catch when we're looking at that and you saw that data.
And in the student loan, we recently published in our newsletter called Analyzing the Student Loan Debt. We have a senior researcher who has like 20 years of experience and he a while ago, he exposed the for-profit education fraud companies like University of Phoenix, and which is no longer public. He wrote this piece, and what I found it interesting is approximately 9.2 million of the student loan borrowers are expected to be reported as delinquent between now and June 2025, in addition to the ones that are already default. a recent court ruling blocking the Saving on Valuable Education SAVE plan will likely impact an additional 8 million borrowers who are also in forbearance, resulting in increased potential for delinquencies in 2025. So what it's saying is there are student loan defaulters currently that is on the record, and there are 9.2 million borrowers who will become defaulters, and there are 8 million student loan borrowers that are protected by the SAVE plan, which is currently in legal limbo. And if the current administration manages to kick those borrowers, they will be added as soon as they come out of the SAVE plan, they will be in the default. So you have a huge amount, and these consumers, let's assume, are some of them are in subprime, and some of them just don't want to pay it and see how it goes as long as it goes, and the rest are completely broke. And I wanted to also point out, we drafted a model of borrower called John Q. Public. Let's say that consumer has a $60,000 loan. And so he will, $60,000 he's making per year. And say if it's around 42 take home pay, you have student loans, say 460 or below per month, if you're actually paying for it. Say auto loan anywhere between 300 to 500. You have car insurance anywhere 200 to 250. You have credit card, you have BNPL, you have rent or mortgage, you have food, you have medical, you have car maintenance, you have miscellaneous expenses. And it just shrinks. Your total take away, all of this leaves majority of the consumers in a negative amount at the end of every month, considering they're actually paying their bills. And if the government forces them to pay the bills, like student loan, then they are screwed.
Mhm.
And I don't understand how many of political talking heads or news media are not focusing, like Melody, you, myself, and Jack are focusing, and John. I don't understand. Are they in deep denial? And another one, if I have a minute extra, I wanted to talk about is, so Rob, who wrote this, mentions that the total amount of student loan debt is 1.77 trillion, up from 1.05 trillion in 2012. So there are two questions he's asking, rightfully so. There are approximately 43 million borrowers, each with an average around $30,000 in student loan. There is a very limited data on the composition of the total debt. How many haven't paid any student loan debt in the last 5 years? Of the amount that they owe, how much of them are principal and how much of them are interest? Because we are seeing student loan borrowers are paying and paying and paying. Like Reddit is full of people trying desperately to find answers. And at this point, it stopped being funny. How much of them are principal and how much of them are interest? Because people are paying $900, $500 every month. And after 8 years, they just pay down only $1,000 of their student loan, and they have no clue. How many of these individuals have car loans? And how many of them are doing some adjustments with FHA? How much accrued interest is in this total portfolio of student loan debt? That data, as far as I know, is not available. And if you both find it, please let me know, because that's a huge problem.
We just hit on, especially that John Q. Public anecdote, that avatar that you built of the average borrower. You know, you touched on virtually every category there that we've talked about, the mortgage, the ABS, not the ABS yet, but the mortgage, the FHA workouts, the buy now, pay later, the credit card, the car loan. And in almost every category, there is some degree of fake or artificial influence on the data reporting and the currency of it, right? The car loans have been artificially suppressed because The banks don't want to repossess the cars. They don't want to send them to wholesale. They're avoiding the losses. The FHA loan workouts that Melody talked about, the student loan delinquencies coming roaring back. All right. So this best economy ever has been propped up by debt that we don't have an accurate view on who's even paying it. We do know that we didn't do a good job of measuring the risk when we issued that debt because the credit scores were falsified. And now here's the last thing that I want to talk about from your bullet list, Laks. You mentioned ABS deterioration, because this is where, even if you're somebody who pays all your bills, this is where this hits you in the wallet, because all of this crap has been bundled up into bonds and sold to your retirement. So what do you think? I know obviously not a very good picture being painted so far, but what do you think this looks like in the ABS market? And I'm not going to hold you to it, but when do you think this reality starts to set in the ABS market?
Well, I would like to, before answering that, I would like to touch one thing. And I think between Melody, you and I, we need another separate period to discuss about this, which how in student loans, how universities are complicit in just creating this huge debt for the students. There are some universities that says how to attend a college as a course, where the students take out the student loan, and there is a private student loan. It's a huge mess. It's just not the loan that the students are taking. It's about some of the loans were co-signed by the parents, right? We haven't touched that. And some of the students are taking courses that they would never, ever get a job in this market. So I read in somewhere in Reddit that there is a communications bachelor's degree holder has a loan of more than $100,000 in debt for student loans. So that is that. I wanted to leave you with that on student loans, where what you see, the student loan defaulters are not just the issue. It's just the top of the huge layer after layer issues are piled up that comes under the student loan. And to answer about the ABS market, we have been following S&P Global and Fitch for this, as well as Moody's. And I will share you some materials recently that we were glancing over. The auto loan ABS tracker and consumer credit ABS tracker along, and I didn't even touch the student loan. Despite the low levels of unemployment, certain prime auto loan asset-backed securities issuers are reporting higher than expected net losses on their pool of loans. The prime auto loan ABS segment is experiencing severe deteriorating performance on more recent vintages, specifically the 2023 and the first half of 2024, while the most issuers are experiencing normalization, and I hate this word with passion. When someone used the word normalization, that is not a good thing. So this is deteriorating, and the verbiage, the terms that they use, normalization in performance back to pre-pandemic level loss levels. So here's what is interesting. When you ask how this ABS is going to cascade into the equity markets, it's through the banks. Some finance companies are reporting significant more deterioration to the loans, driving higher losses. And there are 3 or 4 samples that they took. And one of them is CarMax, Carvana, and there are a couple of other, I think one is VW. So they were trying to analyze how the Mercedes, Carvana's prime issuances, CarMax and VW are experiencing higher deterioration in the prime category.
And Jacqueline, let me just say, if you're in credit, when you have those early delinquencies, something is very wrong. And the fact that this isn't so we're seeing the exact same thing in mortgage. You started seeing the 2021 vintage, experience accelerated delinquency. Then 22 and 23 just took off, as well as 24. So what's crazy to me is that the Steve Eismans or anyone that was around last time absolutely knows when you have early payment default, then something is rotten in the state of Denmark. Very, very, very rotten. And the fact that we're not talking about this isn't front page news, just reminds me so much. Again, and I think this illustrates Locke's excellent point, is that they know they are trying whatever they can not to be the first one out there, and they are colluding and they are talking to one another. And so it's probably going to take something like a rating agency downgrade that happens because in the back end, some bank or some lender is blowing up.
And I wanted to add one point, Melody, thanks for reminding, is that S&P Global, and I could not find it right now, I will share them with you. In May, they published, yet again, the report that I read is from 22nd April 2025. The one in May, they mentioned that the prime auto loan delinquencies are deteriorating further. So usually you see January it's up and Feb it's down,
right?
And the recoveries, so the recoveries are down. The prime auto loan asset-backed securities deteriorations are up, subprimes are up, and the problem is S&P mentioned and Fitch also mentioned in a couple of reports that we are monitoring this and we expect there will be a downgrade in the auto asset-backed securities soon if this trend is not reversed.
So they're
last time they said that was Moody's about US.
Oh, and that you may have noticed that was a thing recently. Yeah.
Yep. They're setting it up.
Now, Melody, we were talking about this before we hit the record button. Credit scores, what, like Locks pointed out, prime is seeing this severe deterioration because these people had 700 credit scores. We called them prime, and now they're delinquent on their car loans. Their credit scores are also dropping 200 points because of that anecdote that we shared about the student loan. All of these ABS that were issued in the prior years that were made up of loans from 2021, 22, 23. Is there any kind of look back on those now that we say, okay, those credit scores have since dropped 200 points. So that bond that we issued 2 years ago, those borrowers are no longer considered prime. Is there any kind of a revaluation going on? What does the market even have?
It'll trigger revaluations. And so I told you, I said the tape, and I realized you may not know what that means, but so in mortgage, auto, all these big securitization markets, every month you get the tape, which is just a big data file. It goes back to when it was a microfiche file or whatever. You get an actual data file that's going to have all of this updated. You're going to have your updated credit scores. You're going to have your updated loan to value. And so I think the way that they've gotten away with not doing great or more provision for loan loss is that the loan to value is like, it's gotten all wonky anyway in auto. And so you're not really looking at that, but you were just looking at those credit scores. So now that those start to drop, if not the rating agencies, the investors are going to be demanding a re-rating of some sort of these securities. And so, this is so when she read that to me, Jack, that was a signal. They are preparing because they know what's about to happen. And these people, nobody's paying attention, but yes, you get this data. And in fact, I look at it in my client books every month. What's my LTV? What are my credit scores? And next month, they're going to look very different than they did this, previous month. So
these hits that are hitting credit scores because of student loans, it's going to hit the auto ABS, it's going to hit the MBS, it's going to hit all these mortgage bonds. And a lot of people that own these things don't even realize they own them because they own them through mutual funds or through ETFs that have bought these things thinking they were safe investments, but they weren't. They were loans to people who haven't paid their bills in years.
And this will seep into, once all these impacts the ABS market, the deterioration is already getting worse, and it will seep into the equity market, and everybody will be surprised.
Yeah, because without First of all, the banks taking the hits, right? The losses that are going to pile up. But on top of this, the consumers that are being cut off from credit, no longer able to patronize all the various stores, restaurants, car companies. This will absolutely eventually translate into stocks, even though right now you go on to FinTwit, there's nothing but uber bullish sentiment. No matter how bad this data gets, it just seems like nothing stops this positivity until, I don't know, until somebody big blows up, apparently.
And we haven't even touched the commercial real estate
Right.
market. We haven't even touched that. And that would be a whole new segment, because there are a couple of uber regional banks
Mhm.
that not any big four will even touch it with a stick to be bailed out. They are shifting bulk of CRE loans into non-performing loans as of Q1 2025. And no one is talking about it, right? It's just,
I think we just teased our next video because
Yeah.
there you
we're
go.
past our hour, and I don't think we can start CRE
No,
now.
we can't.
So, folks, you're just going to have to tune in next time for the rundown on commercial real estate.
There you go.
Yes.
Laks, Melody, thank you so much for your time. I know we ran over time here today, but this was just a really great discussion. We touched on a lot of important things. Well, folks, before we sign off here, I want to take a minute to just show you where you can see Melody and Laks' work. Melody, let's start with you. I know you have a lot of different outlets where you produce your content. Where can we see more of you?
So you can find my written work at M3_Melody Substack. I do videos on my YouTube with different folks, hoping to get Laks on very soon. And then people can always find me on X Twitter at M3_Melody.
And Laks, where can we see your work?
Well, we write newsletters at contrarianunicus.substack.com. And you can also find us at Unicus Research on X.
Okay. And folks, all of those things, we will put links right down below in the description. I highly recommend you check those out. Fantastic information. I know we were drinking from the fire hose today, but you can see all of this stuff in real time on those Substacks and on their Twitter feeds and their websites. I highly recommend you check those out. Once again, Melody, Laks Ganapathi, thank you so much for your time today. And everybody else, until next time, live small and dream big.
Thank you.